Let's start with the banks, shall we? As we kind of get through that piece of earnings season. B of A and Goldman slightly higher today. Like last week, the street will be watching for the impact of high rates. Bank of America, in particular, the biggest unrealized loss of the biggest banks last quarter, $105 billion. Consumer also an area of focus for different reasons, though. They're reporting a rise in charge-offs and delinquencies. Goldman, of course, looking to offload its consumer lending business altogether. What would you do with these stocks?
So, Kelly, when you look at Bank of America, I don't think that there's much that they can say on earnings that's going to fix this downtrend. It's still down 50% since February of last year. And when you look at earnings, they tend to do well. You can actually see that they do generally gap up and they do tend to beat their EPS estimates, but that doesn't mean it's going to change this longer term downtrend. So I think with Bank of America, you look for a short term move higher. We have resistance about $2 higher, right around 28.5. So I think that after earnings, after you get a nice rally, you can short it at that price point.
Ooh, okay. So wait. Because, I see people saying, okay, now that we're getting through bank earnings and that's not a risk factor for them, we can just ride this into year end. But you're saying you'd actually take this opportunity to short them?
Yes, with Bank of America in particular, because this one is in a long-term downtrend. However, if you look at JP Morgan's strong. I like that one for a buy to the upside. Ooh. Goldman Sachs is a little bit different here. Goldman Sachs is incredibly hit or miss on earnings. Over the course of the last 7 quarters, we've seen only 4 beats out of them, and half the time up and half the time down. But here's what I'm going to point out to traders. Goldman Sachs tends to have big moves in the week or 2 post earnings. So what I would rather do with this stock is I'd rather wait until the report, see how the market reacts to it, and then ride that move, because this stock can tend to have some pretty big directional moves after the report.
And you're not trading these as a group at all. I mean, what you said about B of A on the one hand versus JP Morgan on the other, very interesting. Okay, quickly on Johnson & Johnson, what would you do there?
So when you look at Johnson & Johnson, this is a neutral range-bound stock. It hasn't gone anywhere over the span of the last year and a half. And so when you look at the increase in implied volatility we've seen going into the earnings report, I think it makes sense to sell the premium here in the options market. You have about a 3% expected move, but it normally only moves about 2%. So what I'm going to do is I'm going to sell the premium in the options market and buy it back the next day.
All right, let's end on kind of a dire note with Lockheed Martin. They also report before the market opens. They're up 10% since the outbreak of the Israel-Hamas war. It won't necessarily obviously impact the report tomorrow, but maybe there will be commentary on the call. Morgan Stanley is also flagging that Lockheed lowered F-35 fighter jet delivery expectations, hasn't adjusted free cash flow outlook. What's this stock say to you?
So I do like the stock and I own the stock. However, I'll point out that it's lost momentum over the course of the last 2 quarters until the news of the conflict hit. So this stock is going to be entirely dependent on what they say as far as what this conflict is going to do to impact their bottom line. So if we get a positive move out of Lockheed Martin, you'd really need to see it trade up above $14, which is the expected move, to see it continue on with this bullish uptrend. However, if it can't get up above $460, it has that downside momentum, so I would caution longs. However, I'm going to hold on to the stock, and I'm going to continue to look at this one to the upside in the long term.
All right. Let me ask you, because Danielle, the last couple of years, we've had some earnings seasons that were clear ones you were playing to the downside, others that were strong, reflecting the kind of way that markets have traded. Although it's, as we heard, the 800 days now, the S&P is exactly where it was 800 days ago. So this set up for third quarter earnings, but with the key kind of year-end period upon us, what's your overall feel for the market here?
So my overall feel for the market here is to focus on trading in a range-bound manner, especially in the options market, because we have a situation where the VIX is up above 17 and we've had these really volatile earnings reports. And so what that means is that the implied volatility in the options is a little bit higher than normal, especially when averaging in the last 8 quarters. And so that provides an opportunity for traders to come in and sell some neutral premium. I think that that's going to be the best bet with this quarter for earnings, especially due to the way that earnings reacted last quarter. So that's primarily what I'm focusing on. And then the stocks that are truly directional in nature, I will still take some directional picks, but for the most part, I think neutral is the way to go.
All right. Do I dare ask about bond yields? Do you wade into those waters at all?
I don't wade into those waters, but of course I do pay attention to it to see what I want to do with the overall indexes and how that's going to impact the market overall. So when you're looking at the move going into this quarter in earnings, I think that things are a little bit dicey here. We've seen really range bound trade, and of course we've seen those high mortgage rates. But when you're looking at that, you can also see that that's pretty extended.